What's up, everyone? I'm back again for the second time today. We're doing a deep dive into one of my 83 holdings. Again, I know that's a lot, but I love seeing those dividends hit every morning it's scheduled to. It's an important part of an investing strategy is knowing when a position is no longer earning its keep. Today, I'm officially moving on from PFLT, Pennant Park Floating Rate Capital. I've held this for a long time, since March 4th, 2022 to be exact, but the numbers have shifted. I have to be cold-blooded about my capital. I'm going to show you my actual screens and explain why this money is being redeployed into a true quality anchor like Main Street Capital, MAIN. Let's look at the raw data. I currently hold 101.02 shares of PFLT. My average share price is $10.71 with a total cost basis of $1,082.06. Now, look at the market price at the bottom, $8.24. Even with a small daily bump of 2.36%, that gap between my $10.71 cost and the $8.24 market price is a massive red flag. When your cost basis is that much higher than the market value, you're swimming upstream. For a retired investor, seeing that much principal erosion means the stock is failing its primary job, which is protecting your capital. This is where it gets real. Look at the performance screen. My current value is $833.49, but I put in a net cash flow of $1,082.06. That leaves me with a market gain of minus $248.57. A lot of people see that negative number and think, I'll just wait for it to come back. But look at that chart. It's been a jagged downward trend for years. While the rest of my portfolio, stocks like PLTR and NVDA, are hitting all-time highs, PFLT is stuck in the mud. I'm firing this stock because I refuse to let $248 of my principal just vanish while other opportunities are passing me by. This is the most important screen for any dividend investor to understand. This is the definition of a yield trap. Look at my total gain, minus $39.04. How is it only down $39 if the market loss was $248? Because I earned $209.53 in dividends. The trap is thinking that the $200 in dividends makes this a wash. It doesn't. My money-weighted return is down 9.11%. I've held this since March 2022. Over 4 years, and after all that time, including all those monthly dividends, I am still in the red. The dividends weren't income, they were just PFLT, slowly returning my own capital to me while the share price died. That is not how we build wealth on house money. So what's the move? I'm taking this remaining $833 and I'm putting it into Main Street Capital, Maine. Why? Because Maine is an internally managed beast. They don't just lend, they own. When you compare a bleeding BDC like PFLT to a growing BDC like MAIN, the choice is easy. I want a monthly check that comes with share price appreciation, not a monthly check that acts as a band-aid for a falling stock price. I'm cleaning the slate, I'm taking the tax loss, I'm simplifying my 83 holdings, and I'm focusing on winners. Let me know in the comments. Do you have a PFLT in your portfolio that you've been making excuses for? It might be time to fire them. Don't forget to like and subscribe to see how the portfolio looks after I move this into Maine. I'll see you in the next video.